Been a tough year being a property investor? Rising interest rates got you second guessing? Not sure who to turn to for help? You need to reach out to Australian Property Scout, one of Smart Property Investment's most trusted buyers agency. Director Sam Gordon has personally helped many SPI show listeners invest to reach their financial goals using his purpose-built strategies. So what are you waiting for? Head to www.australianpropertyscout.com.au and book in a call with us today.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Good day. How you going? Phil Tarrant here, host of the Smart Property Investment Show. Hope you're well. Recording out of a hotel in sunny Canberra today. It's the last week that Parliament's sitting. There's lots of activity. I've just sat through an hour and a half question time. It was good to remind myself the trappings of the democratic system that is Australia and the logic of debating ideas and thoughts and policies, which eventually turn into law to help shape the way in which we operate and act as Australians. It was good fun. Enjoyed it. Caught up with a whole bunch of ministers, which I usually do when I'm down in town. And a couple of questions in question time around affordable housing today, and not a lot of responses, just a lot of noise either way around no real undertakings, but an acknowledgement that we all need to be working on affordable housing. That said, though, there was some alarming questions coming from some of the independents around freezing rents, particularly in Brisbane. I think the member for Brisbane was pretty much saying it's getting too expensive in Brizzy for renters, and nearly 50% of all Brisbane renters are facing some sort of distress. So they're lobbying for a freezing in rents, and I don't know about that. I know I've just done a review on my portfolio and jacked my rents up a fair bit to market, and I will say it's to market. Maybe our guest today can give us some sense to us, but he's got a bit of a beef, this bloke. He's back. He's one of the regulars on the show, Arjun Paliwal from Investor Kit. For some reason, he's got a love affair with Adelaide. We'll get into that as well. Arjun, how you going? You well?
I'm very well, my friend, and mate, the love affair is not me in the coffee, not me in the place. It's just the data and what the data says. Well,
it's what the data says, and you are a data-driven buyer's agent. You're well known for your data insights. A lot of people look forward to your reports, Arjun, and I pick through them. And I don't necessarily always agree with you, but you're a much smarter person than me when it comes to forecasting suburbs. That's not my job. My job is to talk to people to you, like you, around property investment. But it's been a big year. We're just recording this towards the back end of 2022 as we get ready for the Christmas break and the summer period, where things slow down a little bit. Investors still operating, but I thought we'd use this as an opportunity to maybe look back over the last year, Arjun. We must have caught up 5-6 times, and you've given some pretty firm predictions. And I'd like to really just interrogate how well they've done. Do you think you got most predictions right for 2022?
Look, I'm not a fan of blowing my own horn, as they call it, but I think this year was a pretty good track record year for us. So one in the history books for sure in terms of what went down and what we thought and what actually happened. But I'd be lying to you if I said I was perfect and had everything down packed of what we thought. And it'd be good to go into it and take a trip down memory lane, Phil.
Yeah. So all in all, you got more right than you got wrong?
Feeling happy about it.
Okay. Give me a percentage.
Well, just in some of the notes I was taking earlier, we made 6 out in the public, maybe 8 at the maximum if you include a few podcasts and a few other things here and there. And there was only 2 that we got wrong. So 6 out of 8. So 2 that we got wrong, and keen to deep dive some thoughts on what we got wrong, what we got right. And yeah, but overall 6 out of 8, pretty happy with that.
Yeah, it's not a bad result. And a lot of people will know you, Arjun, for the work you do with the Property Nerds, which is a podcast, which is syndicated on the Property Investment Podcast Network, where you're listening to Smart Property Investment right now. So you're quite familiar with our audience. A lot of people love the Property Nerds, those data-driven property investors. What do you think it is? What's worked really well, do you think, with the Property Nerds this year?
Yeah, firstly, just thank you to everyone who's obviously reached out at the back of that, tuning in, downloads, views, everything. We're exploding. We're going to cross the 200,000 downloads soon, and I'm pretty excited about that, Phil. And when I think of going back to the start of it all, I just feel that property data was put into this too hard, too complex, too boring to talk about across the world of podcasting that was. And everyone likes to be analytical in discussion points, but just focusing in on that is obviously seen as hey, that's too hard to talk about, or too much to go into, and probably too boring for someone to listen to my voice for 15, 20 minutes. So I'd say that what it came down to is realizing that there's an audience there. They want to be heard. They want that type of stuff. And they just want to make sure that they can truly understand the whys behind some of the things that people say. And property is one of these things where there's the same thing that can be said by a certain generation, or there can be certain groups of friends, certain beliefs, but the data, whilst can't be perfect in all ways, it does sift out the truth from the lies. And so I think people just enjoy actually understanding the connecting of the dots and also going, hey, I respect your opinion, but in this case, your opinion may not be correct. So I think it's also a way to respectfully challenge and also review certain myths, trends, and everything like that. And so it's just an audience that I think was always there, but they've truly just now felt like this is the place that I feel safe to tune in and hear about all this.
Yeah, we have literally hundreds of thousands of listeners to the Smart Property Investment Show every month. So a lot of people who tune into this, they're here because they are property investors and they want to learn more about property investment. I get a real kick and satisfaction out of being able to hold and host conversations with people like yourself to help Aussie investors make more informed decisions. But you're quite a darling with the mainstream media. Every time I flick on the television, Arjun's there. If I open up a paper, Arjun's there. So I think more mainstream Australians are being opened up to property investment, and you seem to be a bit of a golden boy at the moment. Tell me about that. What's happening?
Well, I think the 6 out of 8 is definitely helping. Thanks for allowing those set-up conversations as well, Phil. But overall, I just feel that, when it comes to the people helping, it's compounding. But also about a year and a half ago, 2 years ago, we set out a vision that was, to release and produce the most property insights amongst all buyers agents in the country. And I'm really grateful and glad that, we're on track with that vision and hitting that when we look across the board, releasing 40 to 60 page white papers on a monthly basis, releasing 1,000+ word, 500+ word, 1,500 word blogs on deep, insightful, myth busting content each week, monthly podcasts like the Property Nerd. So, and it's not just about your typical principles repeated all over again. Unlike many that chat to you, Phil, we give away the locations here and we talk a lot about locations. And that's one thing I know you've always, been kind to us and complimented us on about the location giveaways that we do. But we do that because we genuinely understand it's not just about who's going to work with us, not work with us. There's a whole gap that exists out there for people that just don't have the right tools, the right knowledge. And we want to be able to, give them as much of that away. And then as a result, there's a select few people who decide, hey, look, we'd love to team up. That happens. But the main thing is just that, we wanted to be the leaders in the space of content, insights, research, and data, hence the Property Nerds.
There you go. And I want to get into what you got right, what you got wrong, Arjun, and thankfully more right than wrong. And to be fair, any buyer's agent that says they get everyone right, you've probably got to put a big question mark against it, because you can't always get it right all the time. You want to hope by using a buyer's agent, you get it right most of the time, but nothing is guaranteed. We'll get stuck into that. Stay with us. We'll just go for a quick break. Back in a moment. Welcome back. It's Phil Tarrant, host of the Smart Property Investment Show with Arjun Paliwal from InvestorKit. You also know him from the Property Nerds podcast, a data-driven insight into how markets are performing. Now, Arjun, this is connected in with that. Last year, we caught up. We spoke about sleepy Adelaide, and that might have been my inference on being sleepy. It's a nice place to be. You pushed back a little bit. Then you felt it would be Australia's best performing capital city for the FY22 financial year. So that's up into June 30 of 2022. It ended the financial year as the best performing capital city, you're telling me. CoreLogic reported 25.7%, outpacing the national average by 11.2%. So what happened in Adelaide? Because normally it just moves at about 5-6% every year. It's a good, constant, consistent performer. It's outperformed this time around.
So I think the bed that it was all sleepy on was just made full of capital growth springs. That's what it was. Was Phil. But overall, I think the key thing to really recognize in Adelaide was how, number one, deep the undersupply was. There's one thing that's often really missed out on property analysis, and it's the conditions of supply. Far too often we get excited about demand because demand's fun to talk about. The infrastructure, the projects, the people flying in, the dollars being spent, the exciting news that can be created off the back of demand is very easy to talk to and fun to talk to. When's the last time someone spoke to you and you said, oh, there's just not many houses to sell, and someone got really excited about your reason to buy for it? So supply is a very boring analysis, and unfortunately, many people, miss out on it. And so rental markets were some of the most undersupplied. even today, as a capital city, the listings are far below pre-COVID averages for sale, and as are building approvals. But that was one key thing. The second key thing is, like most of the country, it wasn't in isolation in its growth. Sure, it was the best performing capital city, which we're really great to see. But like many parts of the country, there was a lot of demand, sales volumes at large levels, lots of money in the economy, cheap money, lots of lending happening. But the main thing that surprises people, and this is the core driver, in my opinion, was the job markets. Extremely diversified pipeline of jobs, infrastructure happening in all directions. And I'm not talking about a train station here or there. I'm talking about city changing hospitals, major roads infrastructure, different projects across different segments of Adelaide too. And one thing I'm always an interesting point in the property analysis world of things is one of the biggest killers of price growth is price growth. And when you don't have a lot of price growth in a certain area over a certain time, there is that kind of regression back to the mean that revert back to long-term trends. And so Adelaide was sleepy, hence the name, for many years prior to the last couple. And when you combine an undersupplied market, a country full of demand, not just Adelaide, the whole country seeing a lot of demand, but that being more undersupplied and having a greater jobs pipeline just helped it stand out even more amongst all capital cities and even amongst many regional cities.
And your sentiments on Adelaide, Arjun, is that this growth should and will continue. I think you're on the telly earlier this year where you said for this calendar year, so 2022 calendar year up until December 31, and that's literally just around the corner now, it would end the calendar year in double-digit capital growth, and it looks like it's on track to do that as well, irrespective of the rhetoric we're hearing about property markets slowing down. So why is Adelaide bucking the trend?
Yeah, so two things that are standing out, the same thing that kept it growing. Number one, it's still very much undersupplied. And so just to give some insights on the numbers behind this, when we look at the start of this year, and this is pre-interest rate rises, one thing that many people have got wrong in analyzing housing trends is that interest rates they felt were the demise of, say, Sydney and Melbourne. The decline and flatten out of these cities actually started in January. It didn't start in April and May when the first sort of rate rises came to picture. And a big part of them were two reasons. Number one is the actual level of supply in these markets was on trend for its 5-year averages. So that means that it wasn't a whole bunch of different amounts of properties for sale. It was all kind of ticking along. And if anyone remembers the 5-year average from 2017, that was just after the peak. And so we were already in flat periods in Sydney from March of 2017, heading down and declining into 18, declining into 19, then recovering back up again in 2021. So at 2022 Jan, Feb, if you've got certain supply levels at a certain 5-year trend in which it declined the last time it was there, then there's no, when you add on interest rate declines, that's just a further fuel to lack of demand and lack of confidence. So the key thing there was the same story in the opposite end was actually more important than the interest rate movements. And it was the fact that Adelaide had 40% below pre-COVID levels of supply. Just people aren't putting their houses on the market. And when they were getting, swallowed up onto the next, just too fast. And so that was the first reason for why it's been a lot more resilient. But the trend has not been upwards in recent months. So it's a little bit late to the party, but it has come to the party. So the key there is to not anticipate the growth of the next 12 months to be the same as it did the last 12. But yes, in terms of that prediction of it doing double digits this year, it was largely due to how undersupplied it was, where even if demand conditions came off, it's always the old relative to each other, rather than just seeing, hey, interest rates have gone up, borrowing capacity is worse, therefore Adelaide must decline. Well, firstly, it needs another 30% jump in houses to sell before things decline. And so it's more so the late to the party rather than doing something completely unique and opposite, just because it's just so undersupplied in comparison to everything else.
And that's the supply and demand equation, which in many markets across Australia, despite rising rates, a lot of the valuations in these areas are holding firm purely because there's less stock on the market and there's no distressed sellers. And maybe some of these areas are also undervalued, but we can have a chat about that in a moment. Now, Arjun, you also said on live TV earlier this year that Sydney would end the calendar year, i.e. 2022, so we've got a month and a bit left, with the decline continuing. You said, or you mentioned a range by memory of 6 to 9%. CoreLogic data coming out in October says it's 8.6% for the 12 months. So that includes a little bit of 2021. Looks like you've hit this one pretty close for the year.
Pretty close. I think it's likely to go just a little over. I just peeped into some of our data points, and it looks like the latest month just came out going into the month following data. So it's crossed that 10 mark. So I'd say, if you want to be nice to me, we can round 10 down to my 6 to 9% range, Phil. But if you don't want to be nice to me, then we can put that in the wrong category.
Data people, Arjun, you round everything to about the 40th decimal point. So, mate, you're some way off on that one.
No, so I think from that perspective, a little bit outside of our decline range. But I think the key is to just come back to the why and the how. So the why is most definitely a three-pronged approach here. When our analysis was looking at this, we looked at inventory levels as one of the core lead forecast tools. We also looked at, the trend of asking prices, vendor discounting, and days on market. So a few core indicators at the starting point of things, just very much short-term metrics. I can't predict the next 3, 4, 5 years of these metrics, but you can kind of see the next 3, 6 months if there aren't any crazy circumstances. So without the whole interest rate increases going up in 7 times, we didn't know that, obviously. We didn't know it was going to go up 7 times. What we knew is that the rate trajectory had started. This is what our thoughts are based on the trajectory. And let's just assume these trends start to play out. It could be 6 to 9. So firstly, a big reason of why it stepped out of those ranges would be the thing that we didn't predict, which is 7 in a row interest rate rises. And that no doubt plays an impact on borrowing capacity, just because they've been so tied to each other. Now, with the borrowing capacity component of things, Sydney has more sensitivity to that change. Yes, the incomes are higher. That's definitely the case in Sydney. But the price to income or the repayment to income ratios are worse off in markets like Sydney than they are in other cities. So even though people are having more funds to go around, the relative funds are a little bit tighter. So those interest rate changes just made a little bit more impact here than we thought it would. And that was the key part of it hanging around the upper ends of that range and probably likely to end the year between 10 and 12%.
Yeah, well, look, to be fair, you're not far off. So I think you can claim that one as a win, Arjun. It's an area here that we're talking about what you got right. And I know you and your team focus on this as a mechanism for predicting markets. That's undervalued and overvalued market, using pricing analysis that loops up a whole bunch of things like interest rates and incomes and where prices currently are to determine overvalue. You've got a lot of these right, by and large, because they've been the most resilient to interest rate rises. And you've got a big list here, Arjun, of undervalued markets. And only Perth and Adelaide are the 2 capital cities. The rest of them are large, rural and regional centres. So these have been able to buck the trend with largely universal price declines across Australia. This is evidence, this is proof to show that just because everyone's talking about decreasing values across Australia, there are still other locations which are bucking the trend and growing in value. You want to run us through some of these, Arjun?
Yes, the list is far and wide. There are definitely many regions across the country still seeing double-digit capital growth, or at least on track for that from an annualized perspective by the end of this year. Now, that should surprise many people, because the thought initially was that interest rates were going to be, carnage across every market across the country. But I often think about recency bias. And this is something very common amongst any human analyzing data. We've just come off a year or a couple of years in which most of the country sees double-digit growth, if not all of it. And as a result, there tends to be this belief that markets always act in this way. That's not the case, Phil. The last time this happened was going all the way back to 2000, 2005. And even then, when it did all move in one direction, it wasn't at the same pace. We had some cities move at 60 to 70% over those 5 years, which, by the way, is a massive result. But then we had little old Bundaberg do over 120% over those 5 years. So this is just unreal to showcase that, even in the times when everything moves, everything does move differently still. So the fact that the recency bias gave everyone this thought that everything moves in that direction, the whole backwards movement also felt the same. Everything grows in one way, so therefore everything must fall in one way. And this universal thinking of everything goes up and down together just stayed with many people. But when you go deep into the overvalue, undervalue analysis, it was clear that those markets that had not had the growth in recent times or weren't as sensitive from income to interest rates and other factors, did continue having that pressure from their strong fundamentals, from their low supply, continue on that little bit longer. So, we talked about Perth and Adelaide as one, but Townsville, Toowoomba, Rockhampton, Mount Gambier, many major regional cities, and you could go on to a few more, Bundaberg, Shepparton, Mackay. And the key here...
A lot of Queensland properties there.
Yeah, Queensland definitely is amongst some of the more rising markets when we break it down by proportion. And if you could break down regional SA into a few more cities, that would be up there as well. Barossa was definitely another key one. And also Victor Harbour, which is another beautiful spot. But yeah, I think the key here is to recognize, if you look at some of the core data points, the Riverina region had over 20% capital growth over the last 12 months. And then we had the southeast of SA, I mentioned parts of Victor Harbour, had 21% capital growth over the last year. And even out to Tamworth had over 18% growth. And then you have markets like Townsville, which had a 21% rise in sales volumes. And that's quite interesting, Phil, because if you think of that, borrowing capacity is reducing 25%, but sales volumes increasing 21% on the year prior. You could argue that could be a net result of 50% gain in demand, even when a force is fighting against you at 25%, taking away your power. You're still wanting to and able to transact at 21% higher levels. And then you've got the likes of Toowoomba, which actually ended up as the fastest selling regional centre with an average of 13 days on market, down from 17. So even after the boom and into 7 consecutive interest rate cycles, it's actually selling faster than it was before. So I definitely feel the key here for investors to really look at is get micro again and not let that recency bias of the last 2 years make you believe that investing is like this forever and ever, where everything goes up and everything goes down together.
One of the things you did telegraph, Arjun, I think pretty well was around the rental crisis and how that will precipitate over 2022, which is a pretty good call. Vacancy rates as low as possible, which isn't helping things if you're on the rental side. It's not a bad thing if you're a property investor. Give me some sense for your sort of wrap up for 2022 on rents. I bet you're saying if you haven't reviewed your rents as an investor for some time, it's probably worthwhile doing it.
Yeah, definitely. I think that's you touched the right point there, Phil, which is investors need to consider their portfolios holistically. Costs have gone up to manage your portfolio. And if looking at rents, consider how they should be reviewed as well. But look, back to market. You don't want to consider making moves for the sake of moves and impacting the other side. I think considering what market level is, but you'll be surprised that market level is likely between $40 to $80 or $50 to $100 more than this time last year in most regions and cities. The last time we experienced vacancy rates this low was going all the way back to 2006 in April at around 0.6%. So that is scary times in terms of, renters and the other side of the mix when you're looking at that longer time until we've, since we've been in the situation. I think the main thing, Phil, is to recognize that more important than the rental crisis and where rents are and where they're going is that when investors are considering investing, they need to appreciate that rents also have a lag effect. And right now, when you are investing, you're going to look at a cash flow calculator like most would. They'll remember the good old positive cash flow days. And then they'll think, hey, I want positive cash flow, and look at a calculator and go, well, that rules out 95 cities out of 100 so-called cities. And this is a decision I think many investors are trying to consider or make in these times, and perhaps sitting back or not thinking of going along the journey because of these thoughts. When really, if you made that same thought last year at interest rates to this level, and say interest rates today were this high, but last year, the rental growth would have gotten you from a likely negative property back to a balanced property just because of the last 12 months and what's happened. And it's likely to happen again for the next 12 months. So the key for investors is don't just consider the yield at purchase. The rents over the next 1 to 3 years are likely on the up at some pretty serious levels. And so you lock in today's purchase price when you are considering investing, and the rent will balance things out.
That's an important point. A lot of people always determine their yield on the purchase price, where I measure it on a number of different ways. I measure it on current valuation. I measure it on total cost to acquire and hold. So don't think that if you're measuring against the original purchase price, you think you got a good yield, you've got to start changing it because those numbers will change. You've got to make sure it's in market. Now, Arjun, let's talk about what you didn't get right. We'll just go to another break. Stay with us. Back in a moment.
Want to slash thousands off your home loan repayments? Whether you're an investor or homeowner, we know how important it is to find the lender that suits your unique situation and with the best rate. If you've not compared your home or investment loan in the last 12 months, you may be able to cut your repayments today with a different lender. That could mean more money in your bank account and less stress when it comes to paying your loan. Find out why more borrowers are turning to Finny to refinance their home loans. Call us now on 1300 002 023 and find out what you could save, or visit our website finny.com.au to book an appointment.
Welcome back. Phil Tarrant from Smart Property Investment with Arjun Paliwal from InvestorKit. Now, Arjun, I'm going to give you a free pass on this first one that you didn't necessarily get right, because most people didn't get this right, including the Reserve Bank of Australia. And most Australians were expecting interest rates sort of down at those record low settings until 2024. And there was a bit of a rude shock when they started hiking at the start of this year. In relation to that, inflationary pressures have exacerbated, continued and got worse in some cases. So that wasn't your read at the start of the year. Didn't get that right necessarily, but there's got to be a bit of forgiveness on that one, mate.
Yeah, look, I thought this was going to be the favorite part of the show where you get to pummel me on all the stuff I didn't get right, but thanks for the kindness there, mate. Yeah, look, I think it's important to also go back to when I made this call. It was probably December, November last year. And the data that I had was coming off the back of a second lockdown. So to me, I'm thinking, okay, we dodged lockdown one, print. You get a free this and you get a free that, and everyone's, on the Oprah show. And then from there, we turned into a second lockdown. Then Melbourne's getting records of its own with the longest in the world. And it just gets pretty crazy. So here's me thinking, okay, we can't dig ourselves into round two of printing to that level. This is going to be tough. Businesses, some will come back, some will disappear, some, are hanged in there and, are able to keep hanging in there. And the read of the data I thought and saw at that time was that, hey, you're going to go into panic mode again if you start increasing interest rates, because there's still so much that needs time to recover and fix. But we came out strong. We came out the other way. And revenge spend truly came alive. That was where it all started, the old revenge spend trend. So cafes filling up, holidays domestically, locally going crazy. My calendar was getting jam-packed with dinners. So I think even before the actual interest rates went up, I knew my call was going to be wrong when I had my calendars full of dinners and stuff, Phil. I think this is just too much discretionary happening here in the early parts of the year. And then out comes RBA starts increasing and, inflation being a core reason for that. So I think the core thing there is that's where we got it wrong. We used the data of leading out from second lockdown thinking, hey, look, we understand house prices will be okay, but I just don't think the economy will start off on a good note. And when the economy is not on a good note, you'd be silly to start ramping up interest rates again. But the economy came out in better shape than anticipated. It continued moving from strength to strength, and then rates followed on the up.
Yeah. And what's your view? Are they going to continue to go? And to your point, there's still a lot of discretionary spending in the market. These interest rates haven't yet had their full impact on Australian consumers and mortgage holders. They still have a few bucks in their back pocket and they're happy to spend. So how much further is it going to go, do you reckon, interest rate rises?
See, I think I've now got a chance to either redeem myself or go get wrong continuously.
We're going to talk about this in 12 months' time, Arjun, so get it right.
So on the interest rate trends, firstly, as you can probably tell, they're the hardest things to try and forecast and think of. But the story that's in front of me is two-part. One part, I'm hella confused with how far these rates will go and where they'll go to, because, what the data said and what it actually did last time were two different things. And so my thinking here is that, let's bring it back to the core thing that seems to be driving a lot of these figures, which is spending and supply channels or pricing, which therefore impacts pricing. So with the supply channels, there are signals across certain, commodities and different things across different parts of the world that they're easing off. There are also, local constraints that were there that are also starting to ease off. So there's an element to supply channels probably improving. and with the rest of the world starting to get more and more synergy, except for obviously, China's lockdown strategy and the zero COVID still being there, most of the world is starting to get back to that level of normality. So from that perspective, the supply things are easing off, and signals suggest they'll ease off into the new year. Now, when you look at the two areas of concern, though, has been that spending is one, and has been some of the demand that will also come in from overseas as we start to open our borders and more things happen there. Now, I think of two things. On those two things there, I think firstly, the spending, when you look to connect it with things like household savings ratio, that was a lot of cash scrolled up. There's still a lot of cash in the system, but the level of savings that was happening in the peak of pandemic periods, the household savings ratio moved up to 16 and even above that as a percentage. That's now come back down to long-term trend lines at just over 8%. So we're not saving crazy amounts of money that we were before, which suggests that interest rates are working, and revenge spending can't go on forever. You can only revenge for so long, Phil. No more, caviars for you on Friday every single time. So,
well, I'm well known for caviar and oysters and a bit of foie gras, Arjun. That's most people know me now. I've probably eaten some fish and chips and some Chico rolls on a park bench somewhere, mate. It's more my style. But
I agree, mate. Surfboard's out.
Yeah, it's all good, mate. Hey, one thing though that I reckon you really waned on this area, and you were pretty bullish about it when we spoke about it a year or so ago. You're pumped on Lismore. You're really pumped on Lismore, and subsequent to that, we've had probably one of the wettest years in our living memory. I think the town flooded 2 to 3 times over the course of 2022. There's a whole bunch of legislation and policy trying to get passed to try and move the town and relocate people. And a lot of people have done it hard with floods up there, mate. And it's still a huge impact right now. Its sales volumes dropped considerably over the year. What's behind that, do you think? Is everyone off Lismore?
Yeah, so this takes me back to obviously, firstly, one of the 8 that we got wrong from the 6 of 8, that was definitely one, and the interest rates the other. But when we go back to Lismore, I want to share with you where it came up. So at the start of this year, we produced a white paper for free called The Top 5 Regions Under 650K in New South Wales. Very glad, but not perfect on this occasion. 4 out of those 5 regions performed phenomenally, even after 7 interest rate rises. So the 4 that performed really well were Wagga, Albury, Dubbo, and Tamworth. Wagga was one of the leaders in New South Wales with over 23%. We had Tamworth with over 17, Albury in double digits, and Dubbo in double digits. So even after the 7 interest rate rises. But one of those 5 in that report of 5 that lagged the trends and didn't really go the way we thought it would go was Lismore. Lismore, as you pointed out, had a decline in sales volume of 29%. And values pretty much flatlined. It didn't really move up or down. A little bit down in some pockets by 2 to 4%, but we'll call it flatline for most of it. Coming back to the rounding principles of data, hey, Phil. But on the note of Lismore, I do feel a lot of interruption, as you pointed out, this year. Created mixes of sales volume, created investors sitting back, thinking of what they do, don't do. There's still a level of undersupply there, but it's not in the natural undersupply components of, people overstimulated in demand, high sales volume, lots of transactions happening, and then the supply falls off. It's actually supply falling off because of all the things that we've seen. Now, on the natural events, which played a key part of why it didn't really, move the way we thought it would, there is data to show in history where you go across the likes of Cairns, Townsville, and other cities, that there is a V-shaped recovery when it comes to floods. We've had lots and lots of data to look at the history of this, and it can turn into a 2-year, V-shaped recovery, 1 to 2 years. So if Lismore can get back to obviously the recovery and, a few other components there back on its data, then it should go back to its strength. But like you said, this wasn't, a small event. This was a massive one and followed by many multiple. So I think there's still an element of, people will feel a bit iffy on that one. But overall, Lismore has and does demonstrate all those characteristics at the time of the data. But unfortunately, those events put it into a pause mode. And if the V-shaped recovery comes back into action, which history suggested always does, then we should see that, come back on its rails over the coming years.
What do people forget so quickly? Flood-prone, flood-impacted areas. It's like they just go, oh, yeah, it won't happen to me. It's 1 in 100 years, even though it happened twice or 3 times in 1 year. Would you be recommending these areas moving forward, these flood-impacted areas?
Yeah, so when it comes to the areas itself, there's obviously mapping, buffers, distance away from the mapping and areas that you can do as mitigation strategies, insurances and all those sorts of things as well as part of those mitigation strategies. Now, there's a sense of buying in a city because you think it's a hotspot, and there's a sense of buying with due diligence in a city because it's a hotspot as well. And so that's the second part that I'd always advocate for. There are things happening all over the country because by that logic, no one should buy in and around Penrith further than Penrith, where a lot of flooding activities happen there as well. And, I think from that perspective, one should still consider cities all across Australia where their economies are stable. There's many, components of their data coming together, but don't ever let that trump the due diligence. The due diligence is going to be key. And that's exactly what I'd say that's happening for many in those regions right now, like the Townsvilles, the Cairns that are performing so well. You want to look back 2-3 years later and know that you got that performance whilst you remain diligent in the way you bought your property and kept away from all those signals. Well,
I've got you, Arjun, and I'll conclude with this question. Back end of 2022, what's your biggest prediction for 2023 for Australian property markets viewed through the lens of property investors?
The one that's staring at me right in my face is definitely the rental crisis continuing. I would not be surprised if we had another year of double-digit rental growth over 2023. The only thing that stops the rental growth in that short of a time period is going to be affordability on rents, not the demand on rents. It's just pure affordability in certain markets that might limit the double-digit growth. The second thing is I do predict that, many cities that are declining will recover and likely see capital growth again at some point in next year. And I do feel that the key thing that's really stopping a lot of the recovery is 2 components right now, and that is in the medium-sized cities that are still undersupplied, it is definitely sentiment, so the desire to act. If I'm not mistaken, just in the recent months' data, we either just crossed or are at even point of the lowest sentiment in recorded history. We've crossed COVID sentiment. So how crazy is that? People feel more uneasy today than when we were asked to be locked down in our homes and not see anyone. So that just shows a state of the fear that's going around right now, Phil. So I think with that in mind, I feel when it comes to recovery, as that sentiment changes, as we see some interest rates balance out, start to pause or balance out or even decline if that occurs over the next year, we may then see prices start to recover because the undersupply in certain cities is far more relatively strong, and it's just waiting for this cloud of, discomfort, bad news, or uncomfortability to disappear, which means buying conditions are probably the best they've been in many locations because either in heavily declined locations, you're buying below peak. If in areas that are showing immense undersupply, strong pressure, but not the same level of growth as before, well, you're buying below sentiment recovery. So for people buying in different locations, you have gains to see in different ways. One is below peak and the other is, okay, maybe it's not declined heavily, but once sentiment recovers, that could really start to unpack it. Very few people understand how strong the fundamentals are in Australia for property investing right now. You pointed out one core one, which was the delinquency. There is no urgency to sell, hence why stock is so subdued. That means that people are waiting for something to change. And whether that's, the interest rates and balancing out, or whether that's people feeling good about everything and starting to come back into the mix. I do think one thing that I'd like to, shout out as a prediction as well, that we might need to recap on the finance front. So not my core area of expertise, but something I think needs to be considered. And this is just my business hat coming on, not a property hat or not a data property nerds hat coming on. From a business perspective, the banks and their credit reached a certain level over the last year, which made shareholders lick their lips. The amount of finance that pumped through the system and ABS data, the data that just shows this curve line jump to never seen before levels was unreal in terms of the amount of finance given out. And even after 7 interest rate rises and a lot of the finance given out, the bank's still stable, profits really healthy. So to an extent, the shareholders know that, hey, we can reach some pretty certain heights, put the pedal to the gas, and then we're still okay. So I think that whilst APRA hasn't made any major changes, banks will continue to make changes behind the scenes to play around with their borrowing capacity so they don't have to give away so much in terms of taking away your borrowing capacity every time a rate rise happens. And we've already seen 2 things change. NAB has introduced 80% of your rental income being taken in now is 90% of your rental income being taken in. That's increased borrowing capacity by 8% for many people, or up to 8%. From that 25%, 30% dip that we saw. And we're seeing more and more lenders apply certain creative strategies. So I feel that lenders will start to go, hey, look, we can't keep shaving off the capacity more and more and more every time this rate rise happens. We need to be more creative to create more finance. Yeah. Otherwise, shareholders upset, customers upset. Who's happy in that picture? So I think next year's a sign of that.
Yeah, and I'll give you everyone a big tip here. Banks love lending money, and that's how they're able to generate profits, and they love in a rising rate environment because it just completely changes the way in which they can generate income. They need to, and their primary objective is to deliver shareholder returns. So the banks will do what they can do in order to continue to lend money despite the rising rate environment. So, and they'll do it through things like you've just mentioned, just changing the equations for determining income. And there's still the big buffer that all banks need to put in sort of 3% on anything based on interest rate rises. So one thing you are guaranteed, that you have a strong partner in the banks in Australia as a property investor. There's 2 things. The government, big partner, they're investing in property investment. They need to, because that's how most people rent properties, is through private landlords. So the government's an invested partner, and the banks are also an invested partner. So capitalise that. It's a great thing called leverage for mortgage holders and property investors. Now, Arjun, I don't know what 2023 will hold. What I do know, and I can guarantee that we'll be here talking about it. So I look forward to chatting with you next year, mate, seeing how 2023 pans out and bring you in to offer insights and commentary to the Smart Property Investment crew. So thanks for your help this year, mate, your insights, and I've really enjoyed it. So thank you. Thank you, mate, and hoping to improve on that track record a little bit more as well. Let's see if you can get 7 out of 8 next time. We'll hold them to account. That's what we do here in the media. We'll, don't always get it right, but you get most things right. So I hope you enjoyed that, everyone. That's Arjun Paliwal. He heads up Investigate. Arjun, you mentioned some reports there. How do you go and get them? That undervalued, overvalued report sounds good. Yeah, so investigate.com.au/whitepapers. It's on our homepage, Property Market Research tab. Every month, we've got a detailed white paper release, and they're all very much the trends, what's happening now. So they're all free to download, and you can grab a copy from there. Cool. Go and check it out. That's Smart Property Investment Show. I hope you enjoyed it, everyone. Remember to check out smartpropertyinvestment.com.au. Social media, Smart Property HQ is where you'll find us. And please keep those reviews coming. We do get a real kick out of them. Keeps us sort of pushing ahead with this show and making sure we're doing the right thing and talking about the right things. We'll see you again next time. Until then, bye-bye. The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Have you signed up to HR Leader? Go to hrleader.com.au to subscribe. Receive the latest HR and people leadership insights and news.